And our featured guest is Steve Kroll, Managing Director of Monness Crespi Hardt. And Steve, I want to start with you. You know, I was talking with some bears earlier today, and you're only adding to the bearish sentiment here. Although, right now, it seems like the bulls really own the market here. I think in this most recent survey, only 16% of investors were bearish.
Well, let me preface by I'm not really a bear. I think we're due for a correction. I think we've had a tremendous market and it's a little bit ahead of itself. And we do have some other issues that we have to confront in 2010, like higher interest rates, China slowing down, and 13 sovereign nations that are on a watch list. So
these are massive issues, right, for a very fragile U.S. economy.
They are, but we do have growth in the United States, and our profits are going to be up 10 to 15%. And interest rates, the Fed has made interest rates so low that it forces investors to look for other investments, whether it's fixed income or high-yielding stocks or general hot names. But overall, I think that the market's going to have a little trouble in the first half and then do better in the second half.
So the Fed does what it can for us. Treasury does what they can for us. The Obama administration puts as much stimulus into the system as it can. But is that enough to kickstart this engine so that the recovery is self-sustaining? That's really the big question, isn't it?
I don't know about self-sustaining, but they have kickstarted the economy. We have two real, mixed messages out there. Obama wants to spend, and I think Geithner and Bernanke really want to kind of exit from the strategy that we've had the last year that has helped us a lot. So we have these real conflicting messages going on out there. Net, I think we're long overdue for a correction, and then I think we'll see how the foreign situation bears out the rest of the year.
What do you think about earnings growth, Steve? I mean, we have heard some very positive forecasts, 20%, 30%. It seems definitely possible from the low levels that we come from.
Well, I think dilution, which we've done a lot of capital raising, is going to hurt some of the earnings. So we're probably airing for the 10 to 15% type gain. The other problem is sales have not really come through, and so it's been all on cost cutting. And when the comparisons on that happen next year, it's going to be tough to cut 20% of your costs again.
Revenues, do you expect revenues to continue to come back? Because in the first few quarters of last year, this year, I'm already saying last year, the first few quarters of 2009, revenues weren't coming up with profits, and then we did start to see a pickup in the last earnings season. A
little bit, but generally we're going to have a very tough situation on revenues. And the average consumer now wants to buy everything at a discount. I don't care if it's a car, a house, or whatever. If you go into a retail store, everything's on discount. So we don't really think that inflation is going to rear its ugly head, except in maybe some of the commodities. But clearly, the psychology of the consumer has changed from the 80s and 90s when it was bid higher. Now it's bid lower.
You don't expect inflation, but it seems like with all this government stimulus that we've had pumped into the system, there's got to be, with all the liquidity running around, there's got to be some inflation as a result of this.
Well, let's just break it down. There has been a lot of stimulus, and we have a little bit of inflation in the commodities, obviously, with gold and crude rallying. But let's talk about the capacity utilization. It's about 73% for most corporations in the United States, which is very low. It's low worldwide. And I also think the psychology has changed. So we have plenty of capacity out there. In case of oil, oil's up, but you have 100 ship tankers out in the seas with, loaded with cargo. So I just don't think that we're going to have as much inflation as most people think. Plus, we have to exit this stimulus program, and we have to start doing it fairly soon on a gradual basis. So that should have a slowdown in the economy. And plus, those 13 countries that I mentioned are on the watch list have to raise taxes for the consumer. So I think the consumer worldwide will have a very difficult year.
It's going to be a tough year. I mean, you got the exit strategy, you got higher taxes, you got a problem with sovereign debt in foreign countries. I mean, what happens to the U.S. economy? Do we have a double dip?
Well, you're going to have a slowdown, but remember, you're putting your money in the money market fund, you're getting zero. So you're still going to be forced to look for other investments, stocks or bonds or what have you. So I think we're due for a correction. It's not going to be cataclysmic, but it can be a 5 or 10% correction. But there are a lot of stocks out there that are still going to do very well, i.e. this year, the Apple. And we had two on our research list. Interoil, which was up 100%, and HGSI, which was up 120%. So there's going to always be ideas out there you can make some money on, even if the market corrects.
Yeah, I mean, look, I remember when you called oil all the way up, you were virtually calling the price changes from your vacation from your BlackBerry as I was on the show. What do you see with as far as commodities are concerned this year? I mean, with all of these problems, with all these headwinds for the economy, do commodities come down?
Well, most of them should, because they're most going to come down because of demand. The only one that people are going to probably continue to buy is probably gold. I don't have any real opinion on it, but that's just a safe haven. And if you don't know what's going on with the 13 sovereign nations, including ours, that has a record deficit, some people might buy it as an insurance policy.
Or the U.S. dollar.
Well, the U.S. dollar I like, because I think our rates have to tick up. I'm a bull on the dollar right here. I think we've had a tremendous correction. As we have these skirmishes around the world, we are the last hope, or the only hope. So I think the dollar will strengthen because of strength here, and also our rates have to tick up, as they've been doing the last couple of weeks.
What do you think about the foreclosure overhang? Is that a concern to you?
It is, but we're working at it. But I worry more about China slowing down. A couple of things. The Chinese market peaked in August. A lot of people think it's at a new high now. And shipping rates, which measures traffic back and forth, have dropped dramatically. So there's some small things there that say that we can have a correction if China slows down a little bit, or they tighten their policy. We could slow down a little bit. But all in all, I would focus mainly on individual names in 2010 and not necessarily worry about we're not going to have a big correction. We'll have a correction and get a better buy point. And I think the latter part of the year, things will, as we exit the exit plan, things will get better.
I wonder, one of the names you like, though, is a home builder.
Yes, we do. There's, as if you mentioned, we have a home builder. We think Lennar.
It's a play that you like. You want to go long Lennar and short St. Joe's.
Right, exactly. Lennar sells at one-time book. St. Joe's sells at over 3 times book, so it's really a hedge. We think Lennar is making progress. There's still some trouble in Florida, but it is making some progress. St. Joe's is I think 3.2 times book. It's vastly overpriced relative, so that's a hedge we have on.
Normally, people pay you for your stock picks. You give them to us for free, so I want to take some time and really go through some of them. One of them you like is Shaw Group, and I'm assuming this is kind of a stimulus infrastructure play.
Both. It's an engineering construction company, but also it does a lot in the nuclear area. And recently there have been some contracts, or the speculation of some contracts let, one by China, also UAE and Britain, all for nuclear reactors, and they would probably be the contractor either through their 20% ownership of Westinghouse Electric or through the Shaw company itself, Shaw Group itself. So we think that that would be as you said, a stimulus play in that nuclear energy area. By
the way, after the decoupling that we all witnessed, doesn't it seem like it's a more global world even than it was beforehand?
It's always, you know.
Let's talk about one that's a play close to home, Bally's, and this has been getting a lot of attention. We've given it a lot of attention because it looks like people in the crunch de credit are working out more. Interestingly, it's not so expensive. Why do you like Bally's?
Well, I got involved in this company 20 years ago, Bally Technologies. It's a slot machine company. And
oh, okay. I'm thinking of a completely different company. You know what I'm thinking about?
No.
The fitness company.
Oh, well, no. That went bankrupt.
You work out outside.
That's right.
All right. So the slot machine company, and you like gaming companies, actually.
I do. I like the slot companies because I think they're like the lottery business was in 1970, where all of a sudden every state that is out of money, or every city that's out of money, is going to roll out new venues of slots. And you've seen it happen. They're starting to talk about it in New York City, but a lot of other states have approved it. Internationally, it's very good. And then you have the replacement cycle. So we think that the slot companies, versus the regular casino companies, which we don't like, will do very well in the next 5 years as people try and increase their tax base or increase their revenues by the states and local governments.
Only 20 seconds left here. Republic Airways, why do you like an air travel company right now?
Well, it's hard to imagine liking an airline, but I looked at an airline. The only airline I know that bought 2 other airlines at the bottom of the cycle, has a lot of debt it's got to work through, but and they just started hiring back people. So I found it intriguing, and I've got to do a lot of work on it. We'll see.
All right, Steve, thanks so much for spending some time with us today.